This is Sarah Cage, and I'm joined again by my co-host Adam Olsen, Embark's National Quality Leader, and we are excited to welcome back Julie Avellanet, a Senior Manager in our National Quality Team. And I watched The Matrix for the first time ever this week. I know I'm 22 years late to the party, but now I have software and all things digital in my brain. So I figured we should talk about software costs and turn it into accounting for The Matrix. So let's jump in and talk about software costs for business. Adam, will you start us off? I know there seems to be a growing number of technology offerings to assist a business in running their operations nowadays, whether that means they're building their own custom software or website, or maybe engaging a third party for a service on the cloud. Maybe they're utilizing digital financial services. Is there a difference in how to account for these different software costs?
Yeah, there is. So, whether an entity acquires or they develop and implement their own software, or maybe acquire and implement a cloud-based solution, like you mentioned, there's a lot of different guidance that can apply to the various costs. So it's really important to understand kind of what's the purpose of what they're acquiring, where the expenditures are, because there is different guidance depending on which bucket you fall into. So that being said, I guess I should caveat, we won't cover all the different aspects of capital expenditures related to technology and software, because we'd probably be here way longer than most people want to listen to. So if you do have instances where you're incurring costs for software that you plan to actually sell, license, or market, we won't cover that today, but look to ASC 985 for guidance there. Or if you're developing software that's used in any research and development topics, follow ASC 730 for that. So putting those aside, what we'll look at today is kind of three different buckets where there is differentiated guidance in US GAAP on how to account for those expenditures, and this relates to internal use software, cloud computing arrangements, which, as you've mentioned, are becoming very, very, very popular, and then website development costs as well.
Okay, so can we start by giving a flyby summary of each of those buckets we mentioned, maybe starting with internal use?
Yeah, so internal use, sounds exactly like what it is. So it's essentially software that a company develops or they obtain for their own internal use. So, a very common example is a large ERP system that isn't on a cloud, is a form of internal use software. Moving along to some of the other buckets I mentioned we'll cover today. So cloud computing arrangements, those are, you often hear people refer to these as software as a service or SaaS, or now there's PaaS and IaaS and all these other as a service arrangements, where you're essentially getting a software service and that's being provided, through some type of hosting arrangement. And there is similar guidance between internal use software as well as certain costs incurred with software and service arrangements that would apply between both. And then that third bucket that I mentioned that we'll touch on today is related to those website costs. And there are some similar principles that accounting for website development costs and internal use software share. And so we'll cover that as well today.
Okay, so let's take an even deeper dive. What qualifies as internal use software?
Yeah, so there's basically two characteristics that have to be met for software cost to be considered internal use. So obviously the biggest one is that either the software you acquired, or if you're developing it internally, or you're maybe acquiring something but then modifying it, it has to really be just done solely for the company's own internal needs. Really nothing in anticipation of trying to then take it to market. So that kind of leads me into the second characteristic, is that during that development or that modification, you really can't have any plans in place that you're making these modifications or developing this software to market that externally, whether it's to sell a license or sell a product itself. You can't have any substantive plans for that.
My judgment alarm just went off and you said no substantive plans. So could you talk a little bit about the judgment that's involved with that?
Yeah, so substantive plan is basically, when you've actually got kind of an outline of how you would take that software solution and have it ultimately reach whoever those prospective customers might be. So you've established what the marketing and sales channel might look like. Whether you be selling something direct to consumers, or maybe you anticipate selling something through a wholesaler or something like that. Also, implementation of that plan has to be reasonably possible. One thing to keep about is that, if an entity has a pattern in the past of externally marketing software products, that they originally developed that were internal use, it's a strong indicator that it really precludes them from being able to say something is going to be internal use software. And really, they need to follow that guidance for software that's intended to be sold, leased, or marketed. And like I said, we won't touch on that today, but if that is where you fall with your expenditures related to software, then again, look to ASC 985.
All right, well, my judgment alarm went off again. You said the words reasonably possible. I'm not going to let you get off that easy. So how should someone think about whether something is reasonably possible?
Yeah, so again, this relates to that plan, as whether it's reasonably possible of implementation, which basically means, hey, is the chance of that plan, occurring, is it more than remote but less than likely? So it's not a huge threshold to kind of fall into that reasonably possible, check the box. Yeah, we've met that. So just keep that in mind. It's more than remote, but like I said, it's not less than likely, which is what you often hear people refer to when they say something is probable. It's kind of that more than likely threshold you hear in other parts of GAAP. So it's less than that for sure to trip this.
Yeah, they wrote that one to be clear as mud, right?
Sure.
What about cloud computing or hosting arrangements? Could they qualify as internal use software?
They could, depending on the facts and circumstances of your arrangement. You could have something that's characterized as a cloud computing or software as a service, hosting arrangement. All those terms are kind of synonymous with each other. You don't see it quite as often. Most of them do qualify as service type contracts, but it is important to evaluate the terms and conditions of your arrangement, because there's essentially two factors that have to be evaluated, and both have to be met in order to qualify that hosting arrangement as internal use software. So the first one is basically the customer has to have the right to take possession of that software at any time during that hosting period. And their right to take that can't come with significant penalty. And then in addition to that, it has to be actually feasible that the customer could run that software independently, either on its own hardware, or they could, contract with some other provider unrelated to the original vendor that could host the software for them. So if either of those aren't met, then your cloud computing software as a service arrangement would not qualify as internal use software. And those factors may sound familiar to some people that have dealt with, like I said, the guidance related to software to be sold, licensed, or marketed, because it's the same criteria more or less that's outlined in ASC 985. So again, look at that guidance. There is some judgment in there to evaluate, but assuming you meet both of those criteria, then the costs incurred with that arrangement could be capitalized as an intangible asset, similar to other internal use software.
So backing up a little bit, can you unpack that first factor when we say cannot come with significant penalty? What do we mean when we say that?
Yeah, so when we're talking about significant penalty, there's kind of two things to keep in mind. So one is really kind of on the cost side. So could you take delivery of that software without significant direct or incremental cost to your organization? And so, this could include things like, forfeited hosting fees that maybe you've already paid, or maybe there's some type of termination penalty or fee that's included in the arrangement if you were to do this. So you kind of have to look at what kind of costs would be incremental to taking possession of that software. And as a guideline, when you're trying to measure like what's significant and looking at those costs, is generally what we see in practice is if the penalty is 10% or more than the total contract fees, it's usually a strong indicator that the costs are significant. And then kind of, putting the numbers aside, you could also have a significant penalty if you're really just kind of looking at the use of the software. And what I mean by that is, companies have to evaluate by taking the software in-house whether or not they would kind of receive a significant decline in the utility or function of that software. So maybe when the vendor is hosting it, it has all these other functionalities and uses. But if the company were to take possession and use it on their own systems or through some other provider, it doesn't come with all the bells and whistles. And so the company would have a significant decline in the ability to use that software. That could also be viewed as a significant penalty.
That makes sense. And I think you also mentioned that both factors, both criteria need to be met. So what happens if both aren't met?
Yeah, and like I said, this is, I would say more often than not, a lot of them do not qualify for one of the various reasons we kind of talked about. So if you don't meet both of those criteria, then basically that arrangement is really just a service contract. All you're doing is receiving services from that vendor. You don't have possession of the software, but instead you're just paying a service fee to access and use their software as needed. They're providing it to you via the internet or some type of dedicated line. And so the accounting for that is basically like any other service contract you have. So you're basically going to expense the fees you pay for that service, and it's going to be, according to the payment terms of the contract, but the expense will be over the contract term.
All right, and let's address the third bucket of software costs. Is there any overlap between the criteria for internal use software and website development?
Yeah, there is. So there's, various stages of developing a website if you kind of think about what all goes into it. So there's, the website application, looking at the infrastructure, what's necessary to kind of run and operate the website. Then you think about kind of just the visual impacts of the website. So developing graphics and layouts and things like that. So similar to like the criteria we have for internal use software, the software underlying the website needs to be developed for the company's internal needs as well. If you're going to capitalize it. And really, you can't have any substantive plans there as well to try to sell, what you develop for that website externally, which I think is pretty common that you're not developing the website to be sold. A lot of times that's if you build templates of websites and then you sell those templates to other people or something like that. But generally, most people are developing their own website for their business's own purposes. So, this one I think is a little less tricky to navigate compared to the cloud computing guidance.
Yeah. So we've clarified those three buckets. We have internal use software, cloud computing, and website development. Julie, I've been leaving you out, so this one's coming to you. With each of those buckets, how do we know what can be capitalized?
Yeah, so we'll talk about internal use software and website development since they're pretty similar in that the cost that you incur could be capitalized depending on the nature of the cost and the project stage during which the cost was incurred. But if you've ever been involved in developing software or a website, you know that a plan never goes according to plan. You may not necessarily follow a continuous order of events with one big final implementation at the end. You might have multiple cross-functional teams working at the same time, but at different speeds. Maybe you're executing just little pieces of the project at a time, and therefore continuously adapting the project as needed. So ultimately, a greater emphasis should be placed on the nature of the cost. And of course, the documentation supporting it rather than the timing of when the cost was incurred.
That's helpful. And what about for hosting an arrangement where a license isn't transferred, but rather is viewed as a service contract? What can be capitalized there?
So if you have a hosting arrangement that's considered a service contract, then generally the only thing that you can capitalize are the implementation costs. So these are your configuration costs, setup costs, implementation costs, and other upfront costs. And that service piece of the hosting arrangement would continue to be expenses incurred, like Adam mentioned. The FASB released ASU 28-15, which confirmed this accounting treatment, and it was actually effective for all entities at the beginning of this year, 2021. That being said, if you are going to capitalize implementation costs, you would actually have to hold it to those same restrictions as if the hosting arrangement that's a service contract was an internal use software project.
Okay, and you mentioned that the stage of a project really drives how the accounting for certain costs are treated. So what project stages do we typically see in developing internal use software?
Yeah, so the guidance breaks it down into 3 stages. The first is your preliminary project stage. That's basically where you're doing all of your brainstorming before you make your final software selection. This includes determining what kind of technology you even need, and also identifying and evaluating your software options. The second stage would be your application development stage. This is where you spend the time actually developing the software. So this would include designing the software, including any software configuration and software interfaces, as well as coding, installing the software to the hardware, and the testing that goes along with that. And then that last stage is called post-implementation operation. It's a mouthful. That stage consists primarily of all of your training and maintenance of the software. So any costs that you incur during the preliminary project stage and the post-implementation operation stage are generally expensed, whereas the costs that you incur during the application development stage are generally capitalized.
That's helpful. So anything that starts with a P, not anything else you can capitalize.
Yeah, you could think of it that way, yeah.
What about the different stages for developing a website?
Yep, so for developing a website, you have 5 stages. You have the planning stage, which again, this is basically your brainstorming stage. Then you have your application and infrastructure development stage. At this point, this is where you're acquiring or developing the hardware and the software that will operate the website. The third stage is graphics development. This is when you're developing the design and the layout of the website, how you're going to make it look, all of the initial creation of the graphics that might involve coding of software as well. The fourth stage is your content development. This would be developing or acquiring the information that will be on the website, and it might include integrating databases or even coding databases directly onto the website. And then that last stage is the operating stage. So this is similar to internal use software. It includes training, maintenance, updates, and other administrative activities that are required to run the website. So generally, costs that you incur in the planning stage would be expensive as incurred. Any costs that you incur in the other stages would require more judgment based on the nature of the cost. And so when you think about that, you would actually apply the same line of thinking as you did for the nature of capitalizable costs for internal use software, and apply that to the nature of the cost for website development as well.
Okay, so it's not a hard and fast rule on whether you capitalize or expense a cost based on the project stage?
Nope. So we talked about how greater weight is placed on the nature of the cost incurred more than at which project stage the cost was incurred. And this is because projects usually aren't a smooth journey with one hard stop. And in real life, you'll probably do your initial implementation of the software, and at a later point, you might make an update that adds the functionality of software and therefore it's capitalizable. You may, for another example, you might be in the thick of doing your application development stage, but then realize you need to revise your plan and then incur additional planning costs that are typically incurred during the preliminary project stage and are expensed. So while we like to consider the stage that the project is in, we care more about the nature of the cost that's incurred for sure.
Because life is messy. So what are some examples of what is capitalized versus expense based on the nature of the costs?
So this time we'll group internal use software and implementation costs with the hosting arrangement, since the guidance is pretty much the same here. So capitalizable costs would include any of the costs of the materials or services that are used in developing or obtaining the software. This could be the fees that you pay to third parties in order for them to develop the software, including any testing that they perform. If you're purchasing the software outright from a third party, the cost incurred there. any cost of integration with your on-premises software, coding, configuration, customization, any cost that you incur to develop or obtain the software that will eventually allow you to access or convert old data with the new system. You would also capitalize any travel expenses incurred by your employees if it was directly associated with developing the software. And along with that, you could also capitalize the payroll and payroll related costs for those employees who are directly involved with the software project. And when I say payroll related costs, that includes, their employee benefits, even share-based compensation. And another cost that you could capitalize are interest costs that you incur while developing your software.
What about the other side? What are costs that are generally expensed for internal use software?
Yeah, so here you would probably see your typical general administration overhead costs, any training costs, costs for maintenance and minor modifications. If you experience any inefficiencies or operating losses incurred, that would be expense. Any data conversion costs, any fees that you pay to third parties for some consulting on general systems and control reviews, as well as your general project planning costs. Those would all be expense.
And then what about website development? I know we already talked about how these have slightly different phases, but how does that relate to what costs can and cannot be capitalized?
Yeah, so for website development, you're probably going to have costs related to acquiring or developing the software that will eventually operate the website. And you'll also have costs for developing the initial graphics for that software. So these costs are either capitalizable or expense, subject to the same guidance that you would apply for internal use software. And then some other costs that you could capitalize for website development would include the cost to obtain and register an internet domain, any modifications to graphics after you launch your website, if it represents an enhancement of the website, any costs to develop or obtain software that are used to integrate a database to the website, any costs to purchase or develop the software tools, as long as they're not used in R&D, and also any other costs that are related to enhancing or upgrading the website that would result in added functionality or features of the website. On the other hand, there's a lot of costs that can be expensed as well. This includes your website hosting fees, any modifications to graphics that represent really just maintenance of the website, data conversion costs, any costs to input content into the website, costs to register the website with any internet search engines, and any costs to generally just run the website, after you initially launch it.
Yeah, I think the one thing to maybe add here is there's a ton of different costs that can lend itself to one way or the other versus how you account for the cost itself, so capitalize or expense. And really it comes down to good documentation of the company and really have an understanding of what costs are being incurred, what they directly relate to, because there could be components of things that maybe have an element that should be expensed or should be capitalized. And especially when it comes to people's time, that you're trying to capitalize time on for projects and trying to understand what did they actually do and when they did it. So documentation is really critical to make sure you have good records of all this stuff to understand where the accounting line should fall between a capitalized and expense.
Makes sense. We love documentation, don't we?
Well, your auditors will make it much easier for you, I promise, if you've got this all buttoned up for them pretty nicely.
What happens if you go live with your website or your software, but then at a later date you upgrade that? Is there a significance threshold there for that upgrade, or I guess what happens if they do upgrade their software or website?
Yeah, so I can take a look at this one. It really comes down to when you have upgrades and enhancements, just what exactly that upgrade or enhancement did. So when there's upgrade and enhancement that add functionality to an existing, software or whatever, you can capitalize those costs. On the other hand, if you have enhancements or you do some minor upgrades or things like that, but it really doesn't change the overall functionality or it doesn't really extend the overall useful life of that asset itself, then, you know, we generally view those types of expenditures as more of just maintenance activities. And so those are just expensed as you incur them. So like I said, there is some judgment here. So it's really understanding what the cost was incurred for and, what actually changed. And when we kind of refer to additional functionality, it's really taking a look at, the software you had before the upgrades and enhancements and what you have after. And are there new things the software can do or perform that it couldn't do previously? That's an indication that you've added functionality to the software itself. So those costs could be capitalized.
And now what if there's kind of a maintenance cost and an upgrade cost happening simultaneously? How does a company know what to capitalize versus expense?
Yeah, so if you're looking at, and this happens quite often, is, you'll have someone providing a service and it could include a significant upgrade, but then some just routine maintenance. Generally you're supposed to look at whether it's possible to separate those costs, obviously considering time and effort and things like that between what is a maintenance and what is maybe more of a significant upgrade. If you aren't able really to decipher between that when you're looking at the costs incurred, then, GAAP's going to tell you basically should default to that all those expenses or all those costs should be expensed rather, and that you really shouldn't try to capitalize anything.
And I want to go back to another cost you mentioned earlier that's capitalizable, payroll and payroll related costs. So how does a company practically determine the payroll amount?
Yeah, and this is where I probably was jumping the gun a bit on, is like, again, it kind of comes down to good documentation policies that you have in place. So when it comes to people's time, particularly when they're working on like an internal use software development project, it's best to have standardized policies in place that explain what are capitalizable payroll costs. Those are communicated to employees, to accounting, to HR, so that everyone really knows what time is spent working on that internal use software specifically. The policy itself is going to go into a lot of the accounting guidance. So it's going to kind of explain the different, project stages and phases, and understand, within each of those stages, what are certain activities that employees could be performing that would be capitalizable. Employees or, maybe some type of time tracking system should have, the ability to kind of track where that time is spent, so that people can keep an eye on it for just, accuracy there. And then, there'll be some type of mechanism in place where management will monitor completeness of time, review the accuracy of where that time was charged, and, make sure everything looks okay. Once all that time's in, then, obviously accounting's got to take it and figure out, based on an employee's standard work week, what kind of conversion rate they might apply to allocate that, that employee's payroll costs or, benefit costs related to their employment between the different categories, and when we're talking about benefits here, it could be, things that include, other items such as bonuses, if they got any type of commission payments, your payroll taxes, things of that nature that also are kind of lumped into overall payroll type costs. So then the capitalizable costs are added to the company's depreciating subledger in their ERP system. And these costs then would be segregated by the associated internal use software that the employee worked on. Or in the case of multiple softwares with different useful lives, they may be allocated amongst, several things.
And we know that all good things must come to an end. So how does an entity know when to start and when to stop capitalizing costs of a project?
Yeah, so let me begin where they actually start capitalizing costs for internal use software. So generally there's two things that'll happen. So one will be that the preliminary project stage should be completed. And the second thing that happens is that management or, the body with the relevant authority that authorizes and commits to funding, a software development project, has done so, and it's probable that the project itself will be completed and the software that they ultimately develop will be, created to perform the functions that it was intended to do. The authorization and commitments, that's done for this software project. It could be in a contract with also other third-party developers. And so if that's the case, you would expect to have approval of the expenditures related to that, to those third-party developers that will be used in developing the software. And then when it comes time to figuring out when you should stop capitalizing costs that you're incurring on a project, this generally happens when management either concludes that it's no longer probable that the software project itself will be completed, or it's not going to be placed in service. Or on the other hand, the software project is essentially substantially complete and the software itself is ready for its intended use.
And Julie, can you walk our listeners through the subsequent accounting after these costs are capitalized?
Sure. So again, here I'll group internal use software and website development together since they're pretty similar. So if you capitalize costs for either of those two buckets, you would amortize it just like you would any other fixed asset. You would determine an estimated useful life for each internal use software or each website, and then reassess it on a recurring basis. And since the digital world evolves pretty quickly, typically we see no more than 2 to 5 years as an initial useful life, unless it's known that the software will be retired or replaced, or maybe the website will be overhauled in an even shorter time frame. And on the other hand, the useful life of the capitalized costs of a hosting arrangement would actually follow the guidance for determining a lease term in accordance with ASC 842. And so under ASC 842, the term would be the fixed non-cancelable term of the hosting arrangement, plus any periods that are covered by the option to extend or terminate the hosting arrangement based on reasonable certainty. So generally, we see that once the costs are capitalized, they're amortized on a straight line basis. Once the software or the hosting arrangement or the website is ready for its intended use. And if it has multiple modules or components, amortization can begin at separate times. But it's important to note that if the functionality of one of those components relies on the completion of the other components, then you wouldn't begin your amortization until all of the components that are involved are ready for their intended use.
And if these costs are amortized, then can they still be assessed for impairment?
Yep, you would actually apply the same guidance in ASC 360, consistent with other long-lived assets.
Are there any common impairment indicators that we see for internal use software, hosting arrangements, and websites?
Yeah, so some common indicators would be, let's say the hosting arrangement will be terminated earlier than planned, or management decides they're going to overhaul the website earlier than planned, or maybe there's a significant change that is made or will be made to the software program. You could also look at the costs. If the cost of developing or modifying your software is significantly exceeding the original budget, that could be an indicator for impairment. If you find that the software, the website might no longer even be expected to be completed or placed into service, that would be an indicator. And some things to look out for here would be, you may find that there's no additional expenditures that are being budgeted or incurred. You might have programming difficulties that just aren't being resolved timely, which could mean that management tends to kick it to the curb. Significant cost overruns. Maybe there's new technologies in the marketplace that management intends to just go outright and purchase instead of completing their software project. You could even look at the business segment or the unit to which the software or the website or the hosting arrangement relates to. And if that business segment or unit is unprofitable and has been or will be discontinued, that's an indicator as well.
All right. And then are there any unique presentation considerations here?
Yep. So presentation for internal use software and websites it's pretty consistent with other long-lived assets, so nothing new there. However, if you have any hosting arrangements that are service contracts, you would have to disclose the nature of that arrangement,
If you have any capitalized implementation costs, you would treat it as if it was a separate major class of a depreciable asset under 360. On the balance sheet, if you have capitalized implementation costs, you would present it in the same line item as any prepayment of fees for the associated hosting arrangement. On the income statement, you would present any amortization of those implementation costs in the same line item as the expense for the fees for the associated hosting arrangement. So it's important to note here that amortization of implementation costs wouldn't be included in your depreciation and or amortization expense, which sounds confusing, but that's the way the guidance is written. On the cash flow statement, you would classify your cash flows from capitalized implementation costs similarly to cash flows for the fees for the associated hosting arrangement, which is generally in operating activities.
Awesome. Well, that brings us all the way from assessment to presentation, which means it's time to wrap this episode up. I think my personal favorite part was learning about people needing to track their time if they're working on a software implementation. I think that's where being proactive can really help, and hopefully we've helped some of our listeners know where they can be proactive if they go through a software implementation or are working on a project that would fall under this guidance. So thank you, Adam and Julie, for taking the time to walk us through that. And thank you, listeners, for following along on another episode of Accounting Matters.